Hey traders, welcome to Charts and Coffee. We're taking a look at the post-CPI environment. We'll take a quick lap through the indices, as well as take a look at where the Fed target rate probabilities sit after that release. As you can see, this is the Russell, by the way, and I've got this up, and you'll see the notes that I keep in the Sector Secrets Mastery room. Our loan setup this morning was a range on the RTY between 2109.7 to 2096.3, looking for a pullback into that area with the immediate reaction. In other words, we park a limit order. We try to take advantage of that wick. It is not a market order. You know, I'm not playing a video game where I'm trying to catch that wick. Impossible, right? And market orders leave a lot of slippage, especially with a high volatility, high impact, hot zone like CPI. So we placed a limit order, and it was a very quick in and out. We got to fill at 2109.7. We got down about 2 points below that. So it's a pretty easy limit order fill, even with that speed. And then you'll see here, our first target was 2120.3. We had gone so far beyond that, we ended up scaling out at 2134, and then price sunk back down through 2120, which would be a great kind of tighten stop, or the break even, and the trade is done. There are really cool opportunities on these kinds of events if you trade futures and can manage the risk of futures. Of course, it's a lot easier to manage risk in modern day futures because we have access to things like the micros. And those are great alternatives to a mini contract where instead of, in this case with the Russell, instead of a $50 per point futures contract, and, you know, think about the risk for a moment. The risk would be 21. So if you're thinking about risk, the risk would be basically 2109. The basic level of risk would be 2109 all the way down to about just below the 2096. So let's call it a tighter stop and call it 2094. That's your risk, right? And that's not a small amount of risk. That's 15 points at $50 a point. Through the whole zone. And that's why I say, you know, we've got to be aware of the risk that we take on. And we've got to be aware of risk to target, right? This is a big one, gang. Risk to target. Sure, at some point I could hit 2120.3 or even in this case, at 2134 we hit. But if it goes down to say 2079, you know, what is your dollar risk, right? And this is where a lot of traders get hurt. They tend to think of trading as simply a target, when in reality, that's incomplete. It's not untrue. It's just incomplete. It's risk to the target. It's the journey to the target. So very commonly, you know, traders, especially in options, will risk 100% of what they paid or max debit, and then they'll take 20% or 40% or whatever off the table. That's an upside down risk reward. In fact, we know that if we're habitually risking 100% and only making, say, you know, 20 to 40%, it doesn't take much of 1 or 2 max debits to drive an account far, far lower, even if the win rate is good. So win rate is not everything, right? Risk to target, how much are you risking on the way to your target is a really important one. And these are just little things that, especially in a high heat hot zone, we have to be cognizant of. Sometimes the risk to the target is too great. So while we might ultimately get to the target, the journey there is untenable, there's no trade. And these are just basic know-how in terms of account growth, whether that's small account growth or Godzilla-sized account growth. And it's also really some basic risk management principles that sadly a lot of traders simply do not follow. All right, let's take a look at where we are on the ES&QYM. A lot of chop. And if you're wondering, Rog, it looked like the year over year was cooler on the core and on the CPI, and that is true. I think some of the flux and the uncertainty about just driving the market higher comes from really two things. One, the month over month wasn't as cool as the year over year. I would say if the Federal Reserve is looking at a bigger picture, macroeconomic, monetary policy influence trajectory, they're not looking month to month with something like CPI, where they can look back year over year. The other thing is the fact that in terms of expectations for rate cuts, we're already there. It's not a matter, as I mentioned in the notes here, this is no longer a matter of if the FOMC will cut, but frankly, by how much will they cut? And we're now just over 30 minutes removed from the CPI, and you'll see it's still pretty much, there you go. Actually, no, there you go. It was a coin flip, and now it looks like much more firmly in the quarter point camp than the half point. Now, still, it's not that much of a difference, but it was more along the lines of 49.51 coin flip. But now you can see there's a much larger chasm where now it's looking very likely that we'll get the quarter point cut, not the half. But the bottom line is on that September 18 meeting, we will get a cut. Now, keep in mind that on August 22nd, we have what would basically be the FOMC meeting for this month, and that actually will be the Jackson Hole Symposium. So we don't have an FOMC meeting in August, but whatever it is that is communicated on this August 22nd Jackson Hole Symposium will be likely the stand-in for the FOMC statement and presser and so forth. So keep an eye on that one. That's going to be our big macroeconomic Federal Reserve related event for the month as we wrap up summer trading. Okay, so that's where we sit post CPI. Pretty darn nice trade, 2109.7 to 2134, and then either a break even or a 2120. So for those of you thinking, okay, Rod, can we crunch some numbers here? Sure. So if you go 2134 as a target to 2109.7, you can see that's 24 points, right? Okay, so 24 is roughly, I'll round down, 24, right, points times $50 a point is roughly $1,200 a contract, right? If you're looking at the initial target at 2120 as the break even, then you close the rest of the trade out there. So 1,200 per contract on that move. That's the way to start a morning, tell you what. Okay, so as always, if you have any questions, feel free to type them in. That's what we've been up to so far this morning in the Sector Secrets Mastery. And let's go ahead and take a look at some questions. Feel free to type them on in. And let's get this daily time frame over in view. All right, let's get to it. First up is, what are my thoughts on Colgate? Yeah, that's one of the few symbols right now in staples that's on the radar. I can't say that I have a setup imminent, although I am looking at potentially the long side. It is trying to organize into an uptrend, as you can see on this daily time frame. Remember, we do have options expiration coming up. So if I open up the CL option chain, right now, I would not be surprised to see Colgate try to get below 100 and stay below 100. I don't believe it's going to get down to about 97.5. That's the next level of significant open interest on the August 16 call side of the option chain. Although if they could get it down to 97.5, they certainly would. That would render the largest group of options, barring a move to 95, that would leave the largest number of options in Colgate basically worthless. So being below 100, I would say, would be pretty good. Now, that just means that if there's going to be a drag on Colgate, and we know that OpEx is really about options expiration and the open interest at different strikes, I would not bet against staying in this area or slightly below 100, if at all possible. I wouldn't be surprised by that. Now, the other thing to consider is what's happening with staples. I still have a long staples position, but we're looking to wrap that thing up, because the more we start to see a recovery in the broader averages, S&P, NASDAQ, Dow, Russell, the less staples are needed, the less they'll be desired. Because remember, staples are defensive, as is XLRE, as is XLU. They're a defensive sector. And unless folks really want to stay on the defense, it makes a lot of sense to ask yourselves, and that's what I'm asking myself too, is there still going to be a lot of demand for utilities and staples as we bounced up from the crash of August, which was greatly exaggerated? And where we have the strength in ES, we might start to see a little bit less interest in those defensive sectors. I'm not saying they're not good sectors to watch, but this is not going to be necessarily. Now, remember, staples and things like that, Colgate's part of that group. He's been very strong for a couple of months. It was the leading sector in July. I believe it's still a leading sector in August. But the more we have a recovery in the broader averages, the less likely, staples may benefit from that defensive posturing. Yeah. All right. Next up is Baidu. All right, taking a look at Baidu here. A week out. This is a bearish chart, Kristen V. This is a bearish chart. There's resistance near term at just below 87, and for me, this is either long puts at resistance or nothing. Yeah, so I would stick with the short side. Or long put side, although, in an environment where we're starting to see a recovery in the broader averages, I would want to be finding things that are bullish. So if I look at the KWEB ETF, of which Baidu is a part of, I'd want to find things that look more like the KWEB, and Baidu looks exactly like it. So I think when you step back and look at KWEB, it's still struggling. So I really wouldn't be in an environment where I'm largely bullish. I wouldn't necessarily be a bull here. If you're looking for short setups or long put setups, that would probably be a pretty good place to look. KWEB and then Baidu being one of the names within it. All right. Tyler asked, do I aim for a price target or profit target? Price target. Oh, dollars versus price? Never dollars. No. There's an old saying, Tyler, and I've sat next to people back in the late 90s, early 2000s. Y'all might remember these trading floors would open up where retail traders could have a desk, have a station, and they could trade at an office. And it was a fun environment. I traded in one of those environments for a number of years, starting in the mid to late 90s till about 2000. And then I decided, you know what? I like being at home with my dogs. So the trading floors, there was a guy I used to sit next to, Tyler, and he always wanted to make $500 a trade or $5,000, but it was always a round number. And if he had an unrealized, and I remember this distinctly, he had an unrealized profit one morning of about 12 and change. And he just had to have 13 because it was the next big number up. And there's a saying, tripping over dollars to pick up pennies. The reason I do not use a dollar number is because what if that's too low? Right? Yesterday on the S&P, we moved to a second standard deviation. That was a big day. So my thought with dollars is it has no reality in the market movement. It's just my reality. And I'm not trading my reality when I'm trading. I'm trading the market psychology, right? So I am not in any way a fan of dollar base. I think that's the question, Tyler. Thank you. It's a great question. It's always where on the chart is there an obstacle? Where on the chart is there a spot at which we could run into resistance or run into support? And so, yeah, in fact, Tyler, I go so far as to keep a sticky note on my desk and I cover up the P&L. I don't want to see it. I don't want to see it. I know where my levels on the chart are. I actually think it's a great practice to even cover up the P&L because those dollar amounts can change our psychology so much. Thank you for the question. Munir asked, can I talk about what I liked about the Darvas after reading his books? I like the process, Munir. Yeah, I like the process. I was inspired by his story. He's not a Wall Street guy. And I was inspired by his automation. You got to remember, back in the 50s and 60s, he obviously wasn't automating things, say, in a Jim Simons way, but he was trying to find repeatable patterns. And when I look back on the early part of my trading career, and a lot of the traders that built me, Schabacher, Dow, Darvas, these were all gentlemen trading. And, Dow dates back to the early 1900s. Same with Schabacher, 1920s. Darvas dates back to the 50s and 60s. And I wanted to find traders who have been doing things in a classic price and or volume-based way, looking for these repeating price patterns. And I'm not a chart pattern fan, but I really like the idea that Darvas, for me, kind of introduced the idea of, he's not really looking for a channel. He's looking for price. And price is dictating where that channel should be. So I really like the price pattern aspect of what he did. Fernando, NEE for a long. This kind of takes us back to the utilities. This is the number one weighted stock in XLU. I have no problem with it. I'd want to wait for a Darvas. There you go. That support level sitting right now at about 76.40, 76.30. I would look for something like that. But I will also keep in mind that the journey is going to be maybe from this lower yellow line at around 76.30 to maybe 80.50, right? So that's going to be, where the containment is on NEE. And again, the concern is whether or not the defensives and the utilities, NEE being the biggest stock in that group, that would be my concern. But as long as that support holds, there's a good shot we make it to the midway point, which is a great first target, or at least a level at which to scale out. And then we could look to see if it does reach the highs and or even breaks it. But that would sort of be the second stage of the trade setup. All right, Baba. Baba is going to be a little bit of a relative outperformer compared to, say, Baidu and other names in the K-Web. It's trying to turn into a trend. It's above the anchored VWAP, but of all the things I could look at, it's probably not near the top of my list. However, that said, getting above and staying above 81.10 could start to generate a little bit more bullish interest because the vast majority of traders and investors, frankly, are momentum traders. There's never a higher high they don't fall in love with. I'm not a fan of that approach. I don't like momentum breakouts. Generally speaking, I'm not a big fan of momentum, especially momentum as late as this. You might say late, Rog, what's the difference? Early momentum would be using a price pattern like a minor low, which would trigger just above 77.30, right? So think about the difference between an early momentum price pattern versus a late momentum price pattern. So this would really be resistance for me at the moment in terms of Baba. And they're two very different structures, right? Keep an eye on the K-Web. And when you look at all the stocks within that, if you can find relative outperformers, great. And when I say keep an eye on the K-Web, what I mean by that is, I like to keep a layout like this. I don't know that I have K-Web on here. I don't. But what I would do is take this layout. I would put K-Web in the upper left-hand corner. And then I'd go find the heavily weighted stocks and list them in order in this layout. And then that way I have a visual relative performance comparison. So I can find the most bearish and the most bullish in terms of their weighting. And that's the way I would look at something like K-Web. But I'll be quite frank, it's just not on my radar. I want to find things that are recovering after that bounce. I want to find things that are above the equator. I want to find things that are more in the bullish hemisphere. Because let's face it, it's very easy to get myopic about current price action and forget that this move from January forward, this is what the broader averages have been doing. So I'm just not a bear. We've had two instances of a lot of drama and bearishness unfolding. One was really related to monetary policy. Obviously, this one was big dumb money around the currency hedges and the yen carry. But ultimately, buying the dips in an environment like this into rate cuts. Remember, the anticipation for rate cuts, the expectation that they're coming, the gearing up for the actual change in the monetary policy based on the cut, that anticipation is bullish, right? What happens after depends on how long we expect the rate cuts to last, what the final target rate is expected to be. So we could continue to see some strength even after the first cut, because then it becomes, well, will they cut again and again and again? But that initial anticipation, which by the way, has been pretty much a fixture since Q3, Q4 of last year, that anticipation of cuts is just a fantastic environment. All right, EA has been a really good outperformer in the XLC, Alan, and it's been stair-stepping the Darvas beautifully. Keep an eye on about 144, and I think you've got a pretty good level to watch. All right, NRG. Nah, of all the things I could look at, again, so David, something against NRG. It's breaking out to higher highs. I'm not going to buy at a higher high. I don't have a trend. So it's not that it's on a decent stock, but there's nothing I can do with this up at a higher high. I need a pullback. I need a support level from which I could buy from. So you can keep an eye on it. It'd be cool if it can turn into an uptrend. It's broken the downtrend. So keep it on the radar if you're looking for the trend to organize. But I think there's probably better things out there that we could trade rather than chop that's already had a pretty significant bullish momentum breakout. All right, gang, that's a wrap. And I will see you all tomorrow, same time, same station. Be good to each other.